Having a financial checklist throughout the year is something most investors strive for. And if you have all your finances in place, this time of the year could be an opportune time to take advantage of tax planning. By planning and strategizing, you could possibly save and reduce on your upcoming tax bill. One element of year-end tax planning involves maximizing contributions to registered accounts. Fidelity Canada's Director of Tax and Retirement Research, Michelle Munro, expands on what you should keep in mind with different investment vehicles. Michelle, welcome. Now, before we jump into some common investment accounts, what should investors be thinking about in general when it comes to year-end tax planning?
Okay, so year-end, this is a great time to review our investment accounts and make sure we're taking advantage of every opportunity that we can. So what I want you to do is start by taking a snapshot, a financial snapshot of what your position looks like. Start with your assets. Okay, bank account, investment account, maybe you own some property, condo, house, maybe even a cottage. Next, I want to look at the liabilities. Okay, maybe credit card debt, student loan, line of credit, mortgage, the list goes on. Assets, less liabilities. This is your net worth. When you understand this financial picture, it's foundational to making informed financial decisions.
Okay, perfect. Lay out that entire financial picture before you get started. Now let's get into the investment vehicles. First up, an RRSP. Can you expand on what type of account this is?
Okay, RRSP. We use so much lingo in our industry. Registered Retirement Savings Plan. A tax-deferred vehicle to be able to save for one's retirement. Okay, you make a contribution, you get a tax deduction. All right, so now we can invest inside our RSP. Common investments are mutual funds, ETFs, stocks, bonds, etc. Now the earnings and the growth inside the RSP on those investments is tax deferred. Typically it's deferred until retirement when you make a withdrawal, and then it's taxing your income then. So your strategy here, when your highest earnings years, you're making your contributions, maximizing those deductions, tax savings, compounding those earnings, tax deferred until retirement, typically in a lower tax bracket. So we get all that tax deferral and tax savings.
Okay, perfect strategies there. What else should investors be thinking about when it comes to an RRSP as the year end approaches?
So it's approaching year end. What I want you to be thinking about, well, what was your contribution limit for the year? Have you made those contributions? Okay. And then, you know what, you actually get a little extra time. You have 60 days after year end to make that contribution, and it will count towards your 2025. You can get a deduction on your 2025 taxes. Good. So 60 days, I counted, is March 1st, 2026, which is a Sunday. So you actually can get until March 2nd.
An extra day.
An extra day, Monday, March the 2nd. Yeah. But you don't want to wait till the last minute.
Right.
If you can, or at least plan out when are you going to maximize those contributions.
Okay, there's another common investment vehicle, the TFSA. How is that different than the RRSP?
Okay, tax-free savings account. Now, when you make your contribution to your TFSA, you do not get a tax deduction the way you do with the RRSP. But inside your TFSA, same account, same investments, mutual funds, ETFs, stocks, and bonds. And the earnings and your growth is now tax-free. When you make a withdrawal, so every year you have your earnings and growth tax-free, you make a withdrawal. That withdrawal is also tax-free, and you can recontribute that withdrawal in a later year. TFSAs are incredibly flexible.
Okay, so you're not taxed on the withdrawal on a TFSA. What other benefits does a TFSA offer?
Well, I want you to think about your TFSA and as well think about what was your contribution room, how are you going to max that out? Right. And you know, it is incredibly flexible. You could use it for your short-term goals or your long-term retirement goals. When it comes to withdrawals though, let's say you're going to make a withdrawal sometime in the near future. Right. Well, It's better to do that in the final weeks of 2025 rather than waiting until the early 2026. Here's why. If you make that withdrawal in 2025, you can recontribute that in 2026. Whereas if you delay until 2026 to make that withdrawal, you have to wait until 2027 before you can recontribute it. So just by making, if you're going to do that, making that withdrawal sooner in 2025 rather than delaying.
Okay, good to know. Now, for first-time homebuyers, Michelle, there is an investment vehicle, the FHSA. Another acronym. Can you expand on this and the benefits there?
Right. So the First Home Savings Account, FHSA, combination of the best of both worlds, of an RRSP and a TFSA. So when you make a contribution to your FHSA, you get a tax deduction the same way you would have with your RRSP. Again, we can invest in our FHSA, mutual funds, ETFs, stocks and bonds, etc. Same investments. And the earnings and growth inside the FHSA are tax-free. And then when you make a withdrawal for a qualified home purchase, that withdrawal can be tax-free as well, similar to the TFSA, so you get a tax-free withdrawal. So tax deduction on the way in, tax-free earnings, tax-free withdrawal.
Okay, that sounds fantastic. You just said that FHSA is the best of both worlds when it comes to TFSA and RRSP. Are there any other unique elements to this investment vehicle?
So the annual contribution room is $8,000 a year. You have to meet certain criteria to open an account, and you mentioned first-time home buyers, primary. And then, but when you open the account, that's when the contribution room starts to accrue. So if you qualify, you're ready to open the account, but you may not have a full $8,000 to contribute in 2005, well, open the account in 2005, you'll get that full $8,000 contribution room, and you can do a catch-up in 2026 or a later year.
Fantastic overview of all these common investment vehicles. Now we know, Michelle, our audience, our investors watching are at different chapters in their different stages in their investment journey, of course. So let's try to break down these key insights into different age groups. So first, for a young investor, maybe between 20 to 30 or 20 to 35, what investment vehicle would appeal to them? So
younger investors, in general, we want to start with a first home savings account or a tax-free savings account. Because, well, saving for that first home, the earlier we can set aside some money, the easier it is. And we talked about the tax advantages there, as well as the TFSA. It's very flexible.
And for a seasoned investor, maybe a little bit older than 35, going into middle age, what investment vehicle would appeal to them?
So here we want to be thinking about typically a registered retirement savings plan.
Gotcha.
A couple reasons. Retirement's getting closer. Oh, gee, you better put some pedal to the metal and start thinking about that. As well as they're more established in their careers, higher earnings, so then they can take advantage of that tax deduction at the higher tax rates.
And for the later chapter in your investment journey, for retirees, what's tailored to them?
Yeah, so thinking about retirees, often they have a fixed nest egg. They're trying to make that last for the entirety of their retirements. Also thinking about estate planning. Well, this group, to the extent that they're able, want to take advantage of the tax-free savings account, because even retirees, seniors, get additional contribution room each year, so maxing that out each year. And it also lays into their estate planning because it's a tax-free account.
All great insights, Michelle. Let's wrap it up. For investors thinking about the year end, what are some real key tax saving elements they can apply to in their investments?
Well, first of all, I want to start off with the importance of starting early. And the next best time is today. And start with that financial picture. Think about what's best for you. First home savings account, TFSA, RRSP. Take advantage of these tax advantaged accounts to really grow your wealth.
Michelle, great insights, great perspectives. As always, thank you so much for sitting down with me, and happy holidays.
Happy holidays.
Another element of tax planning is considering capital gains strategies to minimize or defer the tax owed on capital assets, properties, and investments. We check in with Giselle de Sousa, Tax and Estate Planning Director at Fidelity Canada, to get her insights on capital gains and charitable donations for the end of the year. Giselle, there are some key elements Canadians should keep in mind when it comes to capital gains, charitable donations as the year end approaches. So let me give you a few different scenarios and share with investors how they can tackle each situation, okay?
Sounds great.
So the first scenario, if I'm an investor and I have a large capital gain this year, what can I do to try to minimize that tax from that gain?
That's a great question. So maybe I'll start by going through what a capital gain is. So if you sell a security for more than you purchased it for, you'll trigger a capital gain.
Okay.
So there's a couple of strategies you can look at in ways to minimize that capital gain. So one thing you can consider is tax loss selling. So what tax loss selling is if you have a security that's in a loss position, you can consider selling that security to realize that loss, and then you can use that loss to offset some or all of that capital gain, which will minimize the amount of tax that you have to pay on that capital gain. If you trigger a loss that you don't actually apply all of it against the capital gain, you can carry it back to the previous 3 taxation years to offset any capital gains from those years, and you can also carry it forward indefinitely to apply to future capital gains. One thing to keep in mind is that the last trading day for the year for trades to clear in 2025 is December 30th. So you want to make sure if you're looking into this planning that you do it before December 30th.
Yeah, for sure.
Another thing you can consider is make sure you check your notice of assessment or reassessment, whichever is most recent, to see if you have any capital loss carry forwards. If that is the case, you can also use those to offset any capital gains that were realized in 2025.
Okay, perfect. Wow, some great strategies there. Very helpful. Now, Giselle, this time of the year, a lot of people give back to the community, which is amazing. What are some ways to incorporate philanthropy and charitable giving as the year end approaches?
That's a great question and a great time of the year to be having these thoughts. So there's 2 ways people can typically donate. There's donations of cash or donations of securities. I'll go through each one. So in terms of cash donations, you make a cash donation to a registered charity, you get a donation tax slip, and when you file your tax return, you're eligible to get a donation tax credit. Okay. You can claim donation tax credits up to 75% of your taxable income, and any unused donation tax credits can be carried forward 5 years. On the other hand, if you're donating securities, there's actually more tax benefits. So if you donate a security, if it has an unrealized capital gain, when you donate that security, any capital gain on that amount is not taxable to you. It's tax-free. And then you also get the donation tax credit similar to a cash donation, so you can claim that up to 75% of your income. And you can also carry forward unused donations up to 5 years. So there's additional tax benefits when you're looking at donating securities. Another thing to keep in mind is the Fidelity T-Series. There's tax-efficient ways to donate with the T-Series, and check out fidelity.ca, our Tax Smart Solutions webpage, for more information.
Now, lastly, Giselle, what types of deductions and credits should investors keep in mind as we say goodbye to 2025?
So I'll go through what the difference between deductions and credits are first. So a deduction reduces your taxable income, whereas a credit reduces your tax payable. So in terms of deductions, if you have a child under the age of 16 and you paid for allowable childcare expenses, you can deduct some or all of those amounts. That would include things like day camps, overnight camps, if you paid for them to go to boarding school or for daycare. Other deductions to consider are allowable interest expenses, any investment management fees on non-registered accounts, and any professional dues you paid out of pocket. You want to make sure you paid these amounts by December 31st in order to apply them for the 2025 taxation year. In terms of credits, if you paid any medical expenses out of pocket, you want to make sure you keep track of those expenses and also keep copies of your receipts. You're able to claim a medical expense tax credit for any amounts that are over the lesser of 3% of your net income, or $2,759. Other credits to keep in mind are if you paid student loan interest, if you're a student and you had tuition expenses, or if you made a contribution to a political party, you may also be eligible for tax credits for those expenses.
Amazing. So much there to add on our financial checklist as we say goodbye to 2025. Giselle, thank you so much for those insights, and really appreciate it.
Thank you.
The end of the year is a great time to sit down and reflect on your investment journey, how far you've come, and where you could be heading in the future. And thoughtful tax planning could truly open opportunities to save, strategize, and overall improve your finances. Remember, consulting with a financial advisor is the best way to make the most of your investment journey and future. I'm Emily Nuevo. Thanks for watching The Upside Plus.
Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.